If you're looking for a safe and profitable way to gear up for the rebound in this market, stay tuned. We're covering the poor man's covered call, which can literally double your profits in the next few months. But that's not all. Stick around because I'm going to walk you through one of the top stocks that's primed for this strategy, and we're going to walk through exactly how to set it up and how to manage it for profits on the option trading platform. Before we get started, be sure and hit the like and subscribe buttons down below. Download the free options workshop. It talks about the main benefits of trading options over buying stocks. Disclaimer, I'm not a financial planner. I'm not recommending trades. Please do your own research, and you are the one taking the risk, so you've got to do the ultimate risk. The poor man's covered call is an option trading strategy that allows you to capitalize on the upward movement in a stock and collect profits on the gains in the stock price, as well as sell a covered call or a call against it in the shorter term and collect income. You're doing this utilizing much less capital than it would take to purchase the 100 shares of stock, which one option contract controls outright. How is it different from a traditional covered call? Well, in order to control the 100 shares of stock, you just buy the option. So it is much more capital efficient. It may cost a quarter or a fifth of the price of owning the 100 shares of stock outright. If there's a $100 stock price and you want to control 100 shares of stock, it may cost $1,500 or $1,000 to control that 100 shares of stock with a deep in the money call option or a leaps option. Now, to buy that 100 shares of stock at $100 price would be 100 times 100 is $10,000 to control that 100 shares of stock. So as you can see, it's much more capital efficient, which for traders with a smaller account, it'll allow them to place multiple trades and have cash available for it. So you may be asking, why does a poor man's covered call work well in a market rebound? Well, there's a few reasons. But as you know, the stock market is down right now due to all the tariff talks. And in the next 9 to 12 months, I suspect that these will get resolved and the market will move much higher. Now, the poor man's covered call lets you profit on the upwards movement in the price because the long-term leaps option contract increases in value and you're just utilizing the capital much more efficiently. So that leaps option could double in price alone. At the same time, you're collecting monthly or weekly premium on the short call option that you're selling against the leaps option. And by doing this, on any down move, as long as it stays below that short call price, you keep that monthly premium as it expires worthless at the end of the month. And then you just do it in the following month. So that can amount to several $100s as well as the appreciation in the leaps option contract. Okay, guys, we're going to show how to place a poor man's covered call in one of my favorite stocks, DraftKings, ticker symbol DKNG. This is the Tasty Trade option trading platform. There's a link down below. Use my link and there's some benefits if you join through this. It's a great option trading platform. Now, if we look at the income statement, we can see revenue and net income increasing year over year, as well as the balance sheet is super strong with assets and liabilities lower and growing. Now, if we look at the chart, you can see that it has been trading in a channel moving upward, but it's recently at a low. And this is with the recession concerns and the tariff negotiations. And it's down at a level $33 where it's been very profitable for me using this strategy in the past. And I'll show you what we've done here coming up. But right now it's at the bottom of the channel. I think it's going to continue to go higher. If we look right here on Yahoo Finance, we can see DraftKings, it's trading at $33. The estimated target that they have is 56, and that's about where I have it as well. And then you can see the analysis tab here. They beat earnings the last 2 quarters, and most of the analysts have it as a strong buy or a buy rating. Now, if we look at a couple of articles. Here's one actually right here. 3 incredible growth stocks that are now too cheap to ignore. And it does talk about DraftKings being one of these. It's showing strong economies of scale after years of steady growth. Last year, it added 3.5 million new customers, increasing its customer base 42%. Its scale gives its valuable proprietary data. Having access to data can help it with accurate money lines and point spreads, and it enables it to target promotions as well. So if recession fears grow and other sports data companies decrease in value, it may be an opportunity for DraftKings because of their scale to acquire more companies and more of a data advantage. So long term, it's good. The only concern is the recession, and that's where we're selling that short-term call against it and collecting money on any downside as well. But overall, long term, it looks great. Analysts expect earnings per share to increase more than fivefold this year and another 72% in 2026. And it's trading at just 27 times earnings. So let's go back and open up the trade page. And then I'm going to go out about a year. So 337 days to expiration, the March 20. And then calls are on the left, puts on the right. We're at 33.60. We're going to go to the 30 call in the money, and it's $9.65. So $9.65. If we click on the buy, the ask, that controls 100 shares of stock. Mid price is $9.35. So $9.35 times 100 shares is $935. So less than $1,000. Now, if you were to buy 100 shares, it would be $33.59 times 100. It would be $3,358. So it's less than a third the price. However, we're going to sell a short-term call against it in the next regular option chain, May, and we're going to sell the 35 call. We're going to collect $188, so that's $188. So you see the price comes down to $7.40. We can sell this and collect. We're not quite 45 days out. We're at 29 days to expiration, so we're collecting a little less. But typically, we can collect about $200 a month. And do that out of the money. So up 2 or 3 points away from where the stock is currently trading. So we can make money on the uptrend, and we can collect that $200 per month. So $200 a month times 5 is $1,000. That more than covers your $7.30 price of doing this. And typically in about 6 months, you can control the 100 shares of stock for free utilizing this strategy. We hit review and send and place the trade. Now, guys, I did mention that I've made pretty good money in this, over $4,000 in the last year, over the last year, just trading 1 or 2 contracts and then selling those short-term options against it. And it's worked great. So right now it's at the price where I want to put this on again. And as far as managing the positions, it's pretty simple. If my target's 50 and the stock's trading at 30, I'm going to stay long deep in the money call option and leave that on. I'll put it on at about a year, and in about 3 months, or when it gets down to 9 months or so, 8 to 9 months, I'll close that out on an up day, and then on a down day, I'll go back out to a year if I'm still long that position. At the same time, I'm rolling that short call down on any down move. I'm either closing it out and then waiting for an up move before putting it on in the next month. However, if I collect about 50% or more of premium on a big down day, I'll close out that call side and I'll just leave my long on, my deep in the money leaps option, because ultimately, I know long-term, this stock's going to go up in price most likely. So that's kind of how I manage the poor man's covered call. All right, guys, any questions or comments, let me know in the comments below, and I answer every question. Let me know if you're trading DraftKings or something else, and if you're using the poor man's covered call strategy in this market environment where I see a rebound coming in the next short term, or definitely in the next few months after these tariffs get negotiated. All right, remember to hit like and subscribe down below, download the free options workshop, and I'll see you in the next video. Thanks for watching.